Advanced Financial Accounting. In this presentation, we're going to take a look at two example problems or comparing the results of two example problems, one running the equity method, the other running a fair value method. So in other words, we have one company has an interest in another company. We want to compare and contrast the two methods that can be used given different circumstances. There's rules when to use one or the other, but the two different results as if we use the same method under the same set of facts and see what the results and differences will be on the financial statements on the accounts. So information, we're going to say P is going to be one company that purchases S and 30% interest. So they purchase the common stock of S. P company purchases the common stock of S 30%. Now, typically you would say, okay, well, that would mean you would need to use the equity method because you're over the 20%. But remember, one, the 20% is just kind of not a hard line because there are some exceptions to that rule. And two, we want to run the same method using the same percentage so that we can see the differences in the two methods, and then we can determine why we would want to use an equity method if we have influence, which would be over the 20%. So we're going to be running this. We're going to think about this in terms of the fair value method and then in terms of the equity method for the two journal entries. Now, one of the circumstances that you may still use the fair value method in this case, even though you're at the 30%, is, for example, if somebody else owns a 51% interest, a controlling interest, then your significant influence, although over 20%, might not be there because someone else could just vote and they win because they have 51%, even though you got 30%. So in this case, we're going to say, all right, so this item over here, these are going to be the journal entries related to 2000X7 for the fair value. On the right are going to be the journal entries for 2000X7 related to the equity method. So first they're going to be purchasing for $81,000. That's going to be the first purchase. Then we have S's information. S's information, S is the company that was purchased, or the 30% of stock purchased by P. So S's information, we have the net income, we got the dividends that they paid for 3 years, 2000X7, 2000X8, and 2000X9, and then the fair value information, which we're assuming we would get from like the brokerage statements, right? What's the market price at the end of the year typically is what we're going to be looking at. Okay, so first we have the purchase. Now note under both the equity and fair value method, we have the same purchase journal entry. So it would be a debit to investment in S and a credit to cash for the $81,000. Same thing. Why? Because under the fair market value, under the fair method, we would say, hey, that's got to be the market transaction. It happens to tie out here as well. You might say, well, we got the number from here rather than from here, but not really, because it's a market transaction. So whatever the market says, that's what you're going to purchase it for if it's an arm's length transaction, if there's a negotiation and there was actual exchange that took place. On the equity method, we're also going to basically say, hey, look, that's the best valuation that you can give because that's going to be, the market price as an exchange. So even on both methods, we're going to use that same first initial investment. Then it's going to differ from there. So then what's going to happen is S is going to do these two things. They're going to have the net income and dividends. Also typically what S can do. And then we're going to have the external thing, that what happens outside, that's outside of S's complete control. It's based on external factors, the market, which is the fair market value, people trading the stock and the brokerage information. So under the fair value method, we're going to take this information into account to help us to do our accounting. Under the equity method, we will not. We're going to just take the internal information to help us do our accounting. So under the fair value method, then what we're going to say is, hey, we don't have influence. We don't have influence over here. We can't force them. If they made $43,000 of income in 2000X7, we can't force them to give us the dividend. There's no guarantee they're going to give us the money. We don't have influence. We can't say, hey, give us our portion of the equity. Therefore, justification, or that's one justification in part, to say I'm not going to recognize my portion of the income, but rather I'm going to recognize my portion of the dividends that are actually paid. I'm going to wait till I get actually paid. And usually the dividends will be something less than the earnings. So you can imagine they made $43,000. They gave out dividends total of $14,000. So under the equity method, I'm going to wait till I get the dividend, take my 30%, 14,000 times 30%, increase in the cash by 30% of that 4,200, crediting income. I'm recognizing income when they give it to me. And then I'm going to take a look at the end of the year, and I'm going to look at the external factor to see what my market value is, because I know I can trade the stock possibly for what the external value is. I'm not looking at internal value, I'm looking at the external value. I'm looking at the brokerage statement to say I'm going to do whatever I need to do to tie out my 30% interest to the value that it says my shares are worth on the brokerage statement, resulting in this case in another debit or increase of the 20,000 and recognition of, we're going to say, unrealized gain and loss here. So notice it's not realized, so this is unrealized because we haven't sold it, unrealized gain and loss. Under the equity method, however, we're only going to use internal sources. We're not going to use this external source, and we're going to say, hey, look, we have influence in this case. Therefore, if the company made net income internally of 43,000, we could force them to give us a dividend of the earnings. You know, we could force them to do what we want possibly. Now, we can't completely force them because we only have 30%. We don't have 51%, but that's significant influence. Therefore, we're going to represent our portion of their earnings when they earn it. We're going to represent our portion of their equity, in other words, earnings increasing the equity section, rolling into retained earnings part of equity. So we're going to say there's our 30% of equity increasing the investment here, even though we haven't got cash at that point. We're just representing our portion of the earnings because we think we have significant influence and could convert it to cash. Therefore, you would think, you know, it's kind of the idea if we wanted to. And then we're going to say we're going to be crediting the income in S being that 12,900, the full amount being credited here. So we're not relying on the market to record the full amount of our increase for the value of the net income. We're relying on what's happening internally. Then when they give us the investment or the dividends, we're going to say, okay, the dividends, now they gave us dividends, we've already represent the entire increase here, not based on the market, but based on what the earnings were. So now we're going to decrease the investment. So now we decrease the investment and we record the cash at that point in time for our 30% interest. We don't record the dividend income. So notice these two things are the dividends here, right? Over here we recorded dividend income. Over here we recorded the decrease in the investment. Over here we relied on the market to help us to revalue our stocks to the market value, the 101. Over here, we didn't rely on the market, but what we did is record the full equity earnings of the company, not just that portion of the equity earnings that was given to us. So if we were to post those journal entries, and if we both started out, this is under, again, the fair value method, and this is under the equity method. So if we started out in the same spot, and then we're looking at these investment accounts, at the end of the day, after those journal entries, under the fair value, we end at 101,000. Why? Because we adjusted our books to that 101,000 here that's in the brokerage statements. Then we have two accounts down below that we're going to put on the income statement, both of these, that being the dividend income, 4,200, that's what's recognized. And then we have this unrealized gain or loss. Why? Because we didn't sell the stock yet, but we adjusted it by the 20,000 because that's the adjustment we needed to do to make this number, 101, equal the ending brokerage balance number. So now these two, 24,400 in this case, is the value of the investment or the income that we earned in 2000x7. So again, the dividends are what we really recognize, and this is that unrealized portion of the gain that we're reflecting due to the market swing going up and down. Over here, on the other hand, we have the ending balance at 89,700, not matching what's on the market, what's on the brokerage statement. We're not chasing the swings of the market. I'm not saying the market's good or bad, right or wrong, but it swings. And over here, we're relying on internal equity, on the equity internally. So that could be higher or lower after we account for the market value method. And then down here, we got the 12,900. Again, this account is usually going to be higher than the actual income for dividend income that's reported under the fair value method. But But then the swing that happens here could be higher or lower based on the market, because we increased over here based on internal forms, which you would think would be kind of more stable because it's based on the net income earnings. So you would think that would be a more stable number, and this could have ups and downs and swings. And so notice the difference in the type of revenue recognized to income from S we're going to recognize over here, as opposed to over here we've got the unrealized gain on this side. Okay, so next thing that's going to happen is we're going to say, okay, what happens in 2000x8 if we compare and contrast these two? We got 2000x8 for the market value and then the equity method. So now we don't have the initial investment, but the other two things are basically the same. So we're going to say under the fair value, we're going to say the dividends happened. So in 2000x8, they earned 38,000 and then they paid 29,000. So you would kind of think of that as if I was company S, we'd say, okay, we look like we're gonna make 38,000 this year. Let's give out dividends of 29,000. Now you might say, hey, look, that 29,000 is pretty high. Maybe that's because they're giving some dividends that they earned in the prior year. Like they earned 43,000 last year and only gave 14,000. And that could be the case. This 29,000 could be dividends. My decision-making process as company S might have been, well, we only gave 14,000 last year and now we made 38 this year. Maybe I'll give a little bit higher dividend. But normally we're kind of thinking about this being less than the net income. So we're kind of thinking about this being, okay, the net income went up by the 38,000 and we're giving out, earnings of 29,000 of that kind of. That's how I would basically think about it when you're thinking about the equity method. But they can give out retained earnings represents earnings for the life of the company. So they could give out dividends that were higher than the net income. So in any case, over here then we're going to report then when they give us the dividend. So that's going to be 30% of the 29,000 or the 8,700 cash, and then dividend income. We're recognizing income when they actually give us the dividend. Then at the end of the year, we're going to say, hey, look, what's our brokerage statement say? Our brokerage statement, now the swing of the market went down to 98,000. So now we're going to do whatever we need to do to report our books at 98,000 for our investment to match our brokerage statement that says that's what the market price is. That resulted in us having to decrease the investment by 3,000 this time and record an unrealized loss in this year. So now we actually have a loss that's recorded, the dividends, and then a loss that's recorded, significant kind of swing that happened, right? Whereas over here, we're going to say under the equity method, we're going to say, hey, they earned 38,000. We're just going to represent our portion of those earnings. So we're going to say earnings are going to go up by 30% of that, 11,400, and the investment's going to go up by that same amount. Then they paid us the dividends, 29,000. We've already recorded the full earnings, the increase in the equity. We're not dealing with the market value, the external market. We're not dealing with the swings of the market. We're dealing with the internal flows, which you would think would be more stable over time. And this time we're going to say cash is going to be increasing because we got the dividend. So this matches kind of the dividend transaction over here. Cash is going up, but the other side is not going to dividend income, but rather decrease in the investment, which had been increased by that full 11.4. So if we then look at the accounts, then this is the beginning balance as of the beginning of 2000x8 match, and this was the beginning balance under the equity method. So we were at 101 versus the 89.7. And now this over here, we had a decrease, actually decreasing. Why? Because it was at 101, we tied it to the market, and then it went down. So our stock went down. So we had to then write it down by that 3,000, resulting in an unrealized loss. So now we actually have a loss over here. And then we also had the dividends that were given out. So the dividends were given out the 29%, the 8,700. So 8,700 income. But then we had the swing of the market happen to be a loss this time. So there we have the net income of those two, 5,700. Whereas the equity method, we're saying that we were at the 89,700. We're going to recognize the income related to our 30% of the revenue. And then so that went up. So that meant that the investment went up by that 11,400, and then it went back down by the amount of dividend that was given to us. So in the equity method, you got this nice, kind of up increase. Why? Because in both two time periods, the net income was greater than the dividends that was given, which would kind of make sense. So you would have the equity our portion of the equity is increasing. Whereas over here, we took into consideration the swings of the market, which isn't always, tied down to what actually is happening internal on the equity side of things. So you can have a more kind of a strange swing that's happening over here. So that's going to be the difference there. And then we're going to go to 2000x9, same kind of thing. We're not having the initial investment as we had in year one, but the other two are basically the same. So under the fair value, we're saying cash is going to go up and the dividend's going to go up by the amount 30% of the dividend, 30% of the 19,300. And then we're going to say, okay, now it was at 98,000. That's where we started. And now the brokerage statement it said that it swung back up again. So now the stock's worth 108,000. So now all of a sudden we're going to say, all right, I need to increase my investment by 10,000 because it just went up by 10,000. So, and then the other side's just going to go to unrealized gain to get us back up to that 108,000. So a big swing on the market, not necessarily tied to what happened on the equity side. Although equity went up substantially, it went up higher than the last year. That 10,000 increase looks like more speculation than what's happening internally, right? So then on the equity side of things, we're going to say, all right, now we're going to record our income based on the net income, 30% of the 59,000, which is 17,700. Record the income based on the actual net income, not on the swing of the market. And then when we get the dividend, 30% of that 19,000, these two are the same. Cash is going up under both circumstances, but over here under the fair value, we recorded income at that point. We've already recorded the income under this method, right? Because we recorded our 30% of the 59,000 under the equity method. Our 30% of the 19,000 then is simply going to be us kind of cashing in our investment. So we got cash and now the investment is basically going down. I've already recorded the value of it increasing. Now it's going to be decreasing. If we look at then the trial balances for the final year, we started out at the 98,000. In the fair value, we started out at 92,400 under the equity method. And now down here, you'll see that under the fair value, we increased by the dividend, the 30% of the dividend, 30% of the 19,000, and we increased by this big swing. Why did we have this big swing unrealized gain? Because we had to get this number, 108, to tie out to what's on the brokerage statement. And there was some big swing in the market, right? It was pretty high. So we had that $10,000 swing over here. And on this side, it was pretty high over here too. I thought the 10,000 would be greater than what happened over here, but over here we had the 17,000, so 17,700, which is 30% of the 59,000. So actually the increase in the revenue was higher. Our 30% increase in the revenue was higher than what happened in the market. So maybe I'm saying that wrong. The market didn't pick up maybe the value of the equity that was increased. In any case, the value of the market for whatever reason may not follow the flow of the equity. It could be higher, it could be lower. So, and we're going to tie this out then to the market value. That's what we needed to get to the 108,000 here. And over here, we tied it to the equity. What happened internally, the actual revenue did go up from 38,000 to the 59,000, 30% of that being the 13,700. Over here, the ending number 104,400, not tying out to the 108,000 ending balance. So we're actually lower. If we use the equity method here, we're valuing our asset lower. So that would mean the stock, if we're relying on the stock market from that point in time, it looks like it valued it a bit higher. So that's just going to be some of the difference relying on the external versus the internal factors. And why would you do that once again? Why would you pick one or the other? Well, if you don't have influence, the external factor makes sense because especially if you only have a few shares, you can buy and sell your shares based on what they're selling for. If you have over 30% of the shares, note that if you have over 30% of the shares and you're a controlling interest, have a significant influence, and you tried to sell 30% of the shares, you're probably not going to be able to sell them for the full market price because as soon as people see that you're selling all of them, the price is going to go down, right? Whereas if you only have like 2% of the shares, you can sell the full 2% for whatever the market rate is at that point in time, and no one's going to like have a panic attack about it or anything like that. So that's another reason why if you're not significantly influenced, the market share, kind of makes sense. If you do have significant influence, then what you can actually get from the market share may not make sense. That you want to rely on what the internal value is possibly of the organization.